In this video, I'll share with you 7 types of stocks that you should never buy or own. If you're new to my channel, I work as a finance manager at one of the top tech companies with an MBA in finance and a CPA designation. I post videos about investing and finance a couple of times a week. So without any further ado, let's go over each of the 7 types of stocks that you should never buy one by one. Number 1. Companies you know nothing about. It's risky to invest in companies that you don't know anything about. If you don't know how a company works or makes money, investing in it is like taking a blind guess. I personally think that it's smarter to invest in companies whose products or services you personally use. That way, you'll have a better idea about how the company is performing and what their future might look like. Number 2, penny stocks. Penny stocks are shares of small companies that usually trade for less than $5 per share. They're considered to be highly speculative investments because they're not as liquid, they have limited public information, and they also have high volatility. As an investor, you should be cautious about penny stocks as they're susceptible to manipulation and fraud. Also, these companies usually have uncertain future prospects, which makes them risky investments. Number 3, single product companies. Single product companies rely heavily on the success of just one product for the company's entire revenue and profitability. If that product fails or faces competition, the company's future becomes uncertain. Instead, you should find companies that have a diverse set of successful products. For example, Apple is not only successful because of their iPhones, they have a lot of other successful products like MacBooks, iPads, Apple Watches, headphones, and many others. So even if iPhones become irrelevant, Apple will not go bankrupt. Number 4, overleveraged companies. An overleveraged company means that the company has borrowed too much money, which makes it a risky investment. If the company fails to repay its debts, then it might go bankrupt and its investors will lose all their money. You can tell if a company is overleveraged by looking at its publicly available financial statements and comparing its liabilities against the assets and earnings. If the company owes a lot more money than it owns, then it might be overleveraged. Number 5, declining revenues. Investing in companies with declining revenues can be problematic as it may indicate changing consumer preferences. For me, continued revenue growth each year is one of the most important indicators about the company's performance and future potential. It's generally way safer to invest in companies with either stable or growing revenues. Number 6, declining market share. Market share is the portion of total sales that the company captures in the industry that it operates under. A declining market share can mean a couple of different things. First, it may indicate the company's inability to keep their customers happy. Or it may indicate that there is another strong company that is gaining momentum now. Or it could even mean that there are a lot of other competitors entering the market now. If you want to invest in a company with declining market share, you should make sure that the company has a competitive advantage against other companies and it will not be gone in just a few years. If you see that other companies are being able to offer better products at better prices, then the future of your company may not be bright. And number 7, hype-driven stocks. A hype-driven stock is a type of stock whose price movements are heavily influenced by either short-term hype or trends. If you're planning to invest in such companies, you should carefully consider whether or not the trend is sustainable. And if the trend doesn't continue for long term, is your company strong enough to perform well even without the hype? It's important for you to differentiate between temporary hype and lasting value when you consider investing in trend-driven stocks. So these were 7 types of stocks that you should try to avoid. I hope that you found this video helpful and make sure to check out my other investing videos on my channel. Thank you for watching this video and I'll see you in the next one.